Welcome to part 2 of the episode of Pitch Cafe on the topic how should startups raise funding and what is it that investors and VCs look for when they look at a startup for funding. So we covered two important aspects in the last episode. The first thing was the size of the market of the startup idea you have picked and how valid is the idea for future times. Are you working on an idea which is outdated, or is there a way you can validate and work on an idea which is cutting edge and which is going to evolve in future? And the third thing is the personality of the founder or the entrepreneur who is willing to learn and change with the market and with the times. So these are a few aspects which I covered in my last episode. There's another important aspect which most investors look for when they're funding a startup, and it is the execution of your startup idea. What kind of executional capabilities do you bring in as a team to your startup? Now, when you pick an idea and you start etching out a product out of that, do you have the capability to go out and listen to the market and come back and make changes? Are you a team who can quickly pivot during market changes? And can you demonstrate that, or have you demonstrated that in your past? What kind of challenging problems have you solved? How have you come out of the do or die situations by surviving? So these are several executional capabilities which are very critical, which investor will certainly look at when he looks at your startup pitch or proposal or the executive summary. When your investor is interviewing you about your startup idea, he will certainly take a look at your past experience, and let's say if you have built a product, he's going to ask how many units you sold, what is the kind of margin you were able to derive from each of the units sold, and what was your strategy in building your sales team or your marketing team. What kind of compensation structure you used, and were you able to manage your finances in a disciplined way through changing times? So these are all executional aspects, because your startup is not just the founder or the development team. You're going to have a lot of outward facing, market facing, customer facing aspects to your startup for which you will have less control. All you can do is work on good execution so that your accountability numbers look good and you are able to scale your startup and meet your quarterly revenue targets. So this execution aspect is very important. If you're a second time founder, your investor will certainly look at your past portfolio, companies and how you delivered there and what kind of thinking you bring in. So if you look at some of the aspects or metrics which a VC is likely going to dig deep, or even an investor or an angel is going to really be interested is, what kind of approach you have when you're scaling your company. So there are two kinds of approaches. It's called hyper growth versus path to profitability. What does this mean? Hyper growth or insanely high growth means you go on spending and you go on showing really good numbers. But if you look at the balance sheet of your company, you're overspending. And if you look at the margin you're making, you've not saved anything for the future in case something goes wrong, in case there is another COVID-like situation, or the market crashes, or there is some sort of depression in the market, or the vertical you're working on, it suddenly goes outdated and some other technology takes over. You never know what kind of forces, competitive forces are working on you. In that case, you've not saved any money to cover for your startup survival. So you're spending so much on growth, you're overinflated. If something goes wrong, you're not able to manage yourself. So this is one of the things your investor is going to think about: paths to profitability versus hyper growth or this insanely high growth. So you must have a good account or balance sheet where you're managing your finances and also saving for a rainy day. So this whole behavior is called good financial discipline. Your investor or VC will definitely like it if you display good financial discipline in your practices. So not overspending, not under budgeting, and being slightly conservative in your hiring, cycles, expansion goals. All these things matter when an investor is funding your startup. Now, there are a couple of other metrics. If you are selling a product and if it is, let's say, a Salesforce, then it's a product which not everybody in a company is going to use. Maybe 30 to 40% of the management will be using a product. So if you're a startup who's selling a product which is reaching 30% of a corporation, then what kind of revenue are you making every quarter? So if you make this kind of calculation and after you price it, if you calculate the gross margin, that is all the money which stays with you after your expenses, it should be around at least 60%. You should make that kind of margin. Otherwise, your VC is going to be a little bit worried. He'll be like, okay, are you really going to meet your financial targets? Are you really going to be profitable? So that is one way to look at it. Another way is if you're building a product like Workday, which every employee is going to use, then in that case, you can price your product slightly lesser because there's going to be so much scale. Every employee, let's say it's a company like Cisco, they have several hundreds of thousands of employees and every person is going to use it. So you're going to multiply your product pricing with X 100,000 or something. So you're meeting your revenue target. So in that case, the VC is going to be happy. That's one way he looks at scale. I told you that your startup idea should have a large market size because when you arrive here at your balance sheet and you're looking at your gross margin, how much money you're making, what is the scale of your product, it should be satisfactory. It should show that you are going to be profitable. There are companies like Amazon or Uber, they haven't really hit profitability. They're not able to show, but their projected vision is so big and they have so much market cap in the vertical they are in that the VC will be fine with them. They are still interested. A company like Tesla or SpaceX, the kind of vision they bring when they are raising money and the progress they show, it's pretty convincing that they will be profitable at some point and they have a huge market cap which is not going away anywhere. So this is another aspect they look at, your gross margin. Now there is another concept called potential return. Let's say you're driving a revenue of like 100 million, then your company's valuation will be 40 times that, which is $4 billion. And this is attractive if you have hit the rule of 40. The rule of 40 means your growth ratio and your revenue, which that is free cash, when that ratio hits 40% or greater, that means your company has hit the rule of 40. So if you satisfy this metric, this is just a metric, you can always go refer to it. Look at the terminology, the rule of 40. You're supposed to hit that milestone. The investors and people who want to partner with you, this is just a very thumb rule kind of concept which VCs empirically they just follow it. They don't question it a whole lot. It's called the rule of 40. Your company should hit the rule of 40 in terms of its growth rate and the free cash flow which you have. So if you are able to satisfy this, then your VC is most likely going to fund you. So that is after you have reached some level of scale and growth and things like that. So these are a few criteria which are very important. Today I discussed how executional abilities of the startup team, their ability to display good financial discipline and not overspend, that is path to profitability versus hypergrowth. The third thing is whether or not you're hitting the rule of 40 and your investor believes that you're going to be in the profitable arena of the revenue multiples. They're going to get good returns on investment in your startup or firm in the next few years by being with you, by investing in you, by being your partner in your entrepreneurial journey. So learn about these concepts. The episode 2 on startup funding was slightly more technical. Look up the terms and terminologies which I mentioned, brush it up, and make sure you're able to have an intelligent conversation when you meet your next investor, because you're not going to remain small all the time. At one point you will hit growth. So it's important to read the mind of the investor who's going to go take you to the next level. So with that, I'd like to wrap up the part 2 of the episode on what is it that VCs look for when they are funding a startup, or how to raise funding for your startup. What are a few ways to prepare? What kind of metrics do you focus on to be prepared to raise your next round of funding? So I hope you enjoyed and benefited from this episode. If so, please like and subscribe, share this episode with your friends, and until next episode, I wish you a lot of scale and success. This is your host Vida Patil, here, and I'll see you next time. Thank you.